Hello traders, this is Dave with the Compass Options Live Trading Room, and I'm going to put together a video tonight I did on what I call the WATM strategy. It stands for Weekly at the Money Strategy, and we'll go over the how the strategy works. I like it weekly at the money or a weekly ATM, which is like an automatic teller machine. It's a pretty effective strategy under certain circumstances. And as the market gets to the point where we may start getting some more neutral action or bullish action here sometime, maybe sometime later this year, I wanted to bring this strategy to you so you would have another strategy in your tool belt that you can use to bring in some premium. So let's get started on this. Again, it's called the WATM strategy. And first, I have to give you the disclaimer. All signals and trading opportunities we provide here, orally, written, electronically, are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Brightline Trading are licensed financial advisors. All right, so what is the weekly ATM trading strategy? We just call it WATM for short. Okay, the goal of this strategy is to collect weekly option premiums on a neutral to bullish stock setup soon after the earnings report, within a few days or a week after the earnings comes out. So this is what we're trying to accomplish, is to bring in premium week after week after week on this kind of a strategy. So what's the criteria that we need for these weekly ATM trades? Well, the stock needs to be bullish, and we look for an earnings or a news catalyst. We want a bullish earnings and news catalyst. So if the stock hits earnings, it needs to be a bullish catalyst on it. We're not going to be trading stocks that drop on earnings. We're going to be looking for stocks that are moving up on earnings. And we also want to have, that stock must have weekly options, obviously. We're going to be selling options every week. The stock needs to have weekly options. So that's the second criteria that we need. A third thing, and I'm going to show an example of this, the premiums we collect on the weekly at the money strike. So if we've got $100 of stock that's trading at 100, we would be selling the $100 put. So the premiums collected on the weekly at the money strike must be 1% or more of the stock price. So if you have a stock that's trading at 100 and you sell this week's $100 put, which is at the money, you must be able to collect at least $1 on that premium. So that's important. It's important to be able to collect enough premium to justify the strategy. And so you're going to be looking to collect 1%. A stock that's like $200, you would need to be bringing in $2 in premium on the at the money put option. And I would suggest you avoid biopharmers, any kind of stock that has FDA announcements that come out. They're much too volatile, and we don't want volatility in this strategy. What we're looking for is a stock that's kind of moving sideways or moving up slowly or just bouncing around a little bit. We're not looking for things that are moving up and down really quickly. Okay, so that's the criteria to get into the trade. Once we identify a stock like this, then we will go ahead and go to the next step, which is the implementation of the trade itself. So what we do, once we found the trade that we like, we're going to sell an at the money put expiring this week. Now, if it's Thursday or Friday, then we'd sell them for the following week, because if we're going to sell them on Thursday or Friday, which it's unlikely we'll get enough premium to justify the trade. So we're going to sell the at the money puts expiring this week to start the strategy off. So that's the first leg. Now, the second leg is we're going to buy puts on that stock at a lower strike price 6 or more weeks out in time. And I'll show you an example of this. And if you buy puts on the long puts on the stock that's 6 more weeks out, if they expire after earnings, that's okay, as long as you exit the trade before earnings. It's actually a little bit of an advantage to buy your long puts that expire after earnings. They're going to cost you more, so your initial cost of the trade is going to be a little higher, but it's also going to protect you against time decay on those those long puts, because we're anticipating the stock's going to go up. So those long puts are going to go down in value. That's the whole point. And if they expire after earnings, they're not going to go down in value as much. So when you get to the point that you're going to close a trade out, which is part of the way you close the trade out, is to sell these long puts and collect the money from those long puts. They'll have more premium left in them. Now, the risk on the trade is going to be the difference between the long and short puts, the strikes, plus the debit pay to enter the trade. So if you have like $100 selling at the money $100 put this week, and you're buying a protective put further out in time, 6 to 8 weeks out in time at $95, the risk is going to be $5 or $500 a contract plus whatever you pay to get into the trade, and that is your total risk on the trade. Okay, and this may seem a little complicated, but it's really not. And it's also a trade that doesn't have to be managed too closely generally. Now the trade management, once you're into the trade, so you sold this week's puts and you've bought puts at a lower strike price, out 6 to 8 weeks. What you look at as the week comes to a close, if the stock is near the same strike at expiration, you're going to roll the short put to the following week, bringing in more premium. So if you've sold a $100 put this week on a stock that's trading at 100, let's say at the end of the week it's trading at $99.50 or $100.50, it's right around that $100. Then what you'll do is you'll just roll the put out. So you would buy back this week's short put and sell next week's short put, sell put for next week for the following week's expiration. So you've just recreated the trade with the next week's put. Now, if the stock has fallen below your short strike, but the stock is still bullish, then you're going to sell puts at the same strike as the previous week. Now, what this means is if you sold like a $100 put and the stock is $99 at the end of the week, your put is in the money, obviously. So what you have to do is you've got to buy back that put, and you're going to have to buy it back for more than what you collected on it. But you're going to sell the $100 put again for the following week because the stock is still bullish, and you'll collect a lot more premium than you had the previous week. So what happens is if the stock gets back up to 100 in the following week, this put you've sold will have actually brought in more money than you lost on the first one. So after 2 weeks, you'd be up money. That's how this works. So that's the key. If the stock has fallen below your strike but is still bullish, remember the stock would still need to be bullish. Now, if the stock moves up a strike or two, you want to sell puts at the money price. So if you've got a $100 put this week, and let's say the week it closes at 102, obviously you've collected all the premium on that $100 put. You bank that whole premium, and you would likely go ahead and sell a strike for next week for $102 instead of $100, and collect the premium on that. And again, that would give you more premium because you're selling at a higher strike price. So that would bring in more premium. And then what you do is just repeat this process week after week, as long as the stock stays bullish, and you can keep bringing in decent premiums. So in theory, after 4, 5, 6 weeks, you'll have sold puts for 5 or 6 weeks in a row, and you'll be very profitable on the trade. And you basically, once you're profitable, you can close it out anytime you want by buying back this week's put and selling your long dated put. Okay, so that's the part of the trade management. Yeah, so again, this is if the stock is still bullish, and it's either goes sideways, which you would sell this week's put as the same as last week's put. If it moves down a little bit, you would buy back this week's put for a loss and sell next week's put for a higher premium. And if it moves up a strike or two, you would go ahead and sell the at the money puts at the strike price. So you'd be selling $102 puts. Now, this is management continues here. If the stock moves up parabolically, in other words, we're trying to find stocks that moves fairly slowly, either sideways or up a little bit, not parabolically. Let's say you got $100, you've got a $100 stock that you sold 100 and bought the 95, and it goes up to $110 at the end of the week. What you want to do is you want to close it out at that point, because you'll have a profit in it. In fact, you could sell it out during the week, you'll have a profit in the trade, and you don't really want it to get that far away, because remember the risk is the difference between your short put and your long put. So if your short put's at 100 and your long put's at 95, you've got a $500 risk, the difference between 95 and 100. If the stock moves up to 110, and let's say you sell $110 puts, and you still got a long put at 95, now you get a $1,500 risk per contract, because the stock has gone up so much. And you really don't want to get in that position on a parabolically moving stock. So you would basically just close out the trade, take your money, close it down. Now, if the stock moves up 3 or more strikes, for example, and let's say it moves from 100 to 104, and it's still bullish, and it didn't really go up parabolically, you can either take the profits again here, and if there's still a lot of weeks left till earnings, you can actually sell a long protective put, the $95 put. You can sell, because you bought it as a long, and you can buy another protective put at a higher strike price to control risk. So let's say the stock goes to 104, and you don't really want to have the risk between 95 and 104. That's $900 a contract. Then you would sell the $95 long put and maybe buy a $100 long put at the same expiration date that you had on the original long put, and that would then give you only a $400 risk. And you'll have lost money on the long put that you sold here. But again, you'll be set up to keep bringing in premium for several more weeks at that point in time. If it's close to earnings, then you would just take it off. If it moves up 3 or more strikes and you've got 2 weeks to go to earnings or 3 weeks to go to earnings, you just take the profit and close the trade down. And I know this may sound a little bit complicated, and it takes a little thinking to get used to it, but I think if you look at this and go over this a few times, you'll see how it works. It's really just a calendar spread. I mean, that's all it is. It's a calendar spread that's bringing in premium every week. We're just bringing in weekly premium week after week after week. Now, the other part of the trade manager, if the stock has fallen through your support level, let's say you've got a $100 put you sold and a $95 put you bought, and you don't really want to see the stock fall below 97 or 96, because that's a support level on the stock. If the stock falls through the support and has become bearish, what you do is you buy back the short puts for this week. Okay, you take a loss on those short puts and hold the long protective puts if the stock continues down. It's a profit if the stock continues down. So if the stock goes from, let's say it goes from 100 to 96, and it's broken your support and you don't think it's bullish anymore, you'd buy back this week's $100 put, which you're going to take a loss on, but you would hold on to the $95 put, which would have gone up in value by quite a bit, by the way, because the stock has fallen. And then you would just hold that long put for as long as the stock continues down. And then when it gets to the point where it perhaps finds another support, or you're happy with the profits, then you would just go ahead and close that long put out and take the money. One other little caveat here is, if the stock falls and you happen to get assigned, let's say the stock falls, it doesn't make whatever it falls to, and you get assigned at your short strike price, then all you have to do is just turn around, sell the assigned stock, and sell next week's options. Unless the stock has broken support, then you would sell the stock and hold on to your long puts. So basically, if the stock breaks, drops, and you get assigned on it, you've got two things you can do. You're going to sell the stock anyway. So you sell the stock that you got assigned, and you've still got your long put, which is likely gone up in value. But if the stock is still bullish, you would go ahead and turn around and sell next week's puts. So all you're really doing is washing out the assigned stock. You get the stock, it gets assigned to you, you sell it, you're back to whether you just have your long put, and then you would sell more puts for the following week. And again, if the stock has broken support, you would just sell the stock and hold the long puts altogether. So again, this is the trickiest part of the strategy. But again, you only have to do this once a week. And this is one that I'm going to show as an example here. This is Nvidia. Now this is Nvidia. This is the earnings in Nvidia. You see this volume here. This was a volume candle on Nvidia on the earnings, and you see the bullish catalyst right there. It bounced up on earnings, gapped up, You see how it's just moving sideways here? So this becomes a decent candidate, especially since the stock has been, you know, in a uptrend for a while here. And you're probably going to get good premiums on this. So this is one that you can use. Now, again, you might only want to sell the puts if the stock starts to move higher. You might only want to sell them for 2 or 3 or 4 weeks and then just take the money and leave. You can even do it after 1 week. If you sell it for enough and you collect it, it goes down to zero. You made $200 or $300 on it, then you can just close the trade down and move on. But basically, what we're trying to do is continue to bring in premiums week after week on this. So this is one that I'm using as an example. There are not a lot of good possibilities right now because most of the stocks have been going down, and so there isn't a huge amount of potential stocks to trade. But I wanted to show this one as an example as Nvidia. So I'll actually show the how that's done in the option chain here. So what I'm going to show as an example here is we're going to use this Nvidia. If we're looking to create the this weekly ATM, we would be selling the March 3rd 232.50 puts. This is I'm using as an example. It's trading in around 230. The 232.50 puts, and we would buy the May 19th. You see how far away that is. We buy the May 19th 225 puts. So the difference here is $7.50. So the total risk on this trade is $750 plus the $12.75 debit. This is how much it costs to put the trade on, because of course the puts that are way out here in May with that much time are going to be much more expensive. But you're going to sell the March 3rd puts and get whatever premium there is there. So let me just drop this for a sample and just see if I can get. I want to bring up an option chain over here. All right. So this is an option chain. This is Nvidia. This is Tastyworks. I don't even really trade on this platform, but I wanted to show you how this is structured. So here's the March 3rd option chain right here, and here's the 232.50 puts we were talking about. And remember, I said you need to be able to collect at least 1% of the actual price of the stock. Well, the stock's trading at 232 right now, and so that means you need to collect at least $2.30. But we can get about $4.15 on this one, or $4.20 as a put that we sell, which means if the stock is above 232.50 by the end of the week, you would keep that whole $435. That would per contract. That would just go to you, and then you would sell the next week's. So that's how you actually put the trade on here. So this is your short put that you're selling. Then I switch to the May 19th, and here's the 225 put that I'm buying here. You see it's $16.90 by $17.10, so about $17. And this down here is what it cost me to sell the March 3rd and buy the May 19th, $12.75. So you're paying $12.75 for this. But if this stays at 232.50, you're going to collect basically in this particular case, we're talking about. Let's go back up here. Here you're going to collect. So roughly, we're going to be able to collect about $400 a week on this thing. So if the stock keeps moving sideways and moves up slowly, you get about $400 a week. So after 3 weeks, actually 2 weeks, you'll be up money because the $12.75 is not going to zero. So if you have 2 weeks of option sales here, you'll be somewhere between $800 and $750 and $900 in premium you'll have collected per contract. And then if you want to close it down at that point, you're in the profit, you can do that. Or you can just keep on selling this every single week as the stock moves sideways. You know, a stock moving sideways is absolutely the best. If you could sell 232.50 puts for 4 weeks in a row, you'd have collected about $1,600, and this would probably have dropped. The long put would probably have dropped down, not by an awful lot, because if the stock's trading about where it was when you actually put the trade on, and you've gone through 3 weeks, but you're still way out to May 19th. You're not going to get an awful lot of time decay in that particular long put. So your profits are going to be really, really nice if the trade moves as expected. But that's what the option chain looks like. If you're using it on this one, I mean that's a Tastyworks, but they're all the same. Basically, you're putting on a calendar spread. So that's what we just did, and it was cost $12.75, but we collected about $420, $415 on the 232.50 put. which if Nvidia is at 230, 250 by the end of the week, then we go ahead and roll it out to next week and collect another $450 or $420, whatever it happens to be. But that's the strategy, and it's really, I know it sounds complicated, but it's really not that complicated. And there is some trade management involved. And the key thing is to make sure you pick a stock that is not likely to go parabolic. You can never protect against a stock that's going to drop quickly, but the whole point here is when you have a long put on, like we have the May 19th 225 put, any time the stock drops below your support level, and let's say it goes down to 225, you buy back this put, and then the stock drops from there down to 215. This May 19th long put that you got is going to go up in value a lot. You know, it'll probably go up by $10 or $12, and you'll have a nice profit by basically this protected put will give you some protection. So it does two things for you. It gives you, obviously, it gives you the ability to stay stock short if the stock goes against you, and it also lowers your premium risk, your margin risk, how much you're putting a risk on the trade by setting up this calendar type spread. So that's how a weekly ATM works. I'll be talking about it more in the room. And again, it's really for people that like to trade options and understand them. You need to get familiar with how this works. But it's really a good strategy. But it's only a good strategy when the market is cooperating, which it hasn't for the last year, which is why I haven't really done much with this. I only did like 3 of them last year, maybe 4 of them last year. And you know, they were all profitable, but you have to. It's hard to find the stocks that fit the criteria that we need. You don't want stocks that gap a lot. Gapping stocks are not what you want, because if they gap up, then you're probably gonna have to close the trade out anyway, because it's basically a parabolic move. And if it gaps down too far, you're gonna have to buy back the put for loss and hope that it continues on down. So we don't want stocks that gap a lot. We want nice smooth movements in the stock. So that's why I just showed Nvidia as an example, but we would go through these. And you don't want to be doing this on biotechs, and you don't want to be doing this on cheap stocks, like $15 stocks or $20 stocks. You want to be doing it on stocks that are at least $50 or so that you can get some decent premium, and you know it'll try to stay within a range. All right, so that's the weekly ATM that we call it, that I call it. It's a strategy I've used for several years, but I haven't used it this year very rarely. I did selectively do it, I think 4 times, and made profit each time. But the market had been way too jittery as far as moving up and down, and it's not something you want to do in a bearish market. You want to do this on a neutral to trending market, because you want the stocks to move sideways or up. You don't want them moving steadily down. And somebody asked me about doing the opposite. If it was bearish, could you do this with calls? And the answer is you shouldn't do it with calls for 2 reasons. One, most stocks bounce, recover. The general direction of the market is bullish over time. They generally recover, which would put you in kind of a bind. And the second thing is you can get more premium on the puts than you can on the calls, because there is so much hedging done with puts that it jacks up the premium on them, which is good for us because we're selling that premium to bring in money each week. So that's the weekly ATM. Just cover quickly here the Compass Options Trading and what the goals are we have here. Is again, we're trying to help members become consistently profitable under all market conditions. This weekly ATM strategy is kind of like a time spread strategy. It's something I use to bring in premium, and I'm trying to help people become profitable under all market conditions. I think everybody knows the market conditions have been absolutely horrible in 2022, and February is probably one of the hardest trading months that I've seen in 13 years. We're trying to teach members the most effective use of the Compass and Dominator systems. That's really important as well. I mean, if you're looking for one of these stocks, you can obviously check the Compass system and make sure that on the daily chart that you've got green. You want the daily chart to be green on these particular stocks. We're trying to educate members on identifying and trading the highest probability trade setups while being patient. Really important to learn to be patient. Our goal is not to make trades. Our goal is to make money, and we make money by making trades, but only by taking the very highest trades. And I'm trying to have a room that accomplishes these goals. in a relatively low stress and discipline environment. You're not going to have no stress when you got money on the line, obviously, but we want these goals we want you to be able to reach these goals without having to go to antacids every day to try to calm yourself down when these trades are whipping around. So that's why we try to find stocks that have the highest likelihood of working and be disciplined about how we trade these. And I just did put in 22 trading environment recap again. Again, 2022 was a year-long bear market, the worst market since 2008. Most difficult trading environment in many, many years, absolutely. Many retail traders were not able to adjust their strategies and mindset, and they blew up their accounts or simply gave up. And I know countless number of people that applies to. Swing trading was particularly difficult because of the many gaps up at the open and the violent bear market rallies. This is something we hope to get away from. I would like to do more swing trading. I haven't been able to do a lot of swing trading in the room. I do some, but it's tough. You can't get the same win rates that we got in 2021 and 2020 just because the market is not really that conducive to swing trades. So a lot of our trades are intraday. And time spreads. Time spreads have been doing very well. I think we just closed 4 or 5 time spreads in a row for profit. So it's doing very well. And again, if you survive the 2022 trading environment, you're well positioned to be a consistently profitable trader going forward. And if you did that, I congratulate you. And here's our performance recap again for 2022. All live room trades, we had 340 total trades, 298 wins, 86%, 45 losses, 13%, 4 scratches. Profit factor 2.16, which is very nice profit factor. Now we went to the dominator system in October is when it came out. So I looked at the trades from October to the end of December when the dominator system was available. So what I looked at here was 151 total trades, which we used the compass system only. In other words, these trades did not have the dominator system lined up with it. It wasn't negative, it wasn't against them, but it just was neutral. In other words, the dominator had no bias for long or short, so it was just a neutral market internals. So we had 135 wins, 89.4%, 14 losses, and that's 9.3%, and 2 scratches. Profit factor 3.57. So the profit factor went up to 3.57 in the second half of the year. I think you get better at using the compass system as time goes by. Now, when we use the compass and the dominator in combination, so these would be trades that the compass system was lined up green or red, and the dominator system also had either buy or sell signals at the time. So the market internals were giving us either a bullish bias or a bearish bias, enough that they were putting out signals. So when we had those trades, we only had 123, and you can see that they're fewer, of course, because the two compass system and dominator systems don't line up all the time. A lot of times the compass system is you can trade off the compass system, but you don't have a dominator system to go with it. But we had 123 trades, 119 wins, 3 losses and 1 scratch, 96.7% win rate, which is astronomical. And again, we're being very, very selective. And the profit factor of 12.41 is which is off the charts as far as the profit factor is concerned. That takes your wins and losses and how much there was in wins and losses into consideration. And you was also trying the SPY super system during this time, which the SPY super system is basically the dominator system and the SPY compass information lines up. So you've got a dominator system with a green signal, a compass system with the SPY that's all green, and we buy the SPY off of support or sell it at resistance. And I was testing it as a beta test. I called a couple of them out in the room, but not an awful lot. But I had 100 trades, 86 wins, 86%, 10 losses, 10%. So the win rate wasn't as high, but notice the profit factor. Profit factor was 14.17. Profit factor was higher. So our even though we had less win rate, lower win rate, still 86 is 86% is very, very good. This profit factor was better. So we basically were able to manage those trades so that we either made more on the ones we won, or we lost less on the ones that we lost on. So that's just kind of a recap of 2022 and what we've been working on here. And there's a link to the Compass video library where all my training videos are out there. So that's it, and that's called the weekly ATM. Again, it's a strategy we can use. I'll be mentioning it in the room. If people want to follow me some of the trades, they can. You might want to do it on paper. If you're not familiar with not really good with options, you might want to wait on something like this until you really have a good grasp on it, because I know it appears pretty complex, but it's not. Once you understand it, it's not complex. But if what you're understanding here is the goal of the strategy is to collect weekly options premium on a neutral to bullish stock setup as soon after earnings as the report comes out, because it gets us in early with a lot of time, a lot of weeks until the next earnings report. It's because we want as much time as we can between the time we take the trade and earnings, because we can keep selling puts every week on that until we're take down whatever profit we want to take down. So anyway, that is the weekly ATM strategy. I hope you enjoyed it. I'm sure you'll have some questions, and we'll discuss it again. If anybody wants to, I can probably do a live webinar on this at some point to answer some questions if there's a demand for that. So again, thanks very much for listening. See everybody in the trading room. Good luck, everybody. Let's make money tomorrow.